Tesla stock has been one of the greatest performers over the last few years, and it's been well earned. We'll talk about that in just a second. The question is, where does the stock go from here? Is it possible that you might see a reset with Tesla stock, TSLA? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own shares in Tesla. And so as we look at Tesla stock, first of all, incredible performance, nearly 1,800% return over the last 3 years, and it's been well earned. What you have here is just incredible growth in their top line. First of all, you can see just in the last couple of years that it's more than doubled from around 20 billion in automotive revenue in 2019 to 47 billion in 2020. And during that period, because of their best practices, you saw their automotive gross margins dramatically expand from around 21% to 29%. So they are delivering something really solid, and they're getting leverage on the operating expense, perspective as they build out new factories that can automate this. They're going from effectively break even to significant profitability, around 12% plus margins. And from a company that was previously on death's door, where they were burning more cash than they had on hand, $3.5 billion in cash burn 2017 versus $3.3 billion in cash on hand. Nowadays, this is a company generating billions of dollars in profit, and they still have over 10 billion, nearly 20 billion in cash on their balance sheet. And so the question is, will it keep on running from here? And so, first of all, they're continuing to execute. Elon Musk continues to open up new factories. Here it is, he's dancing to the latest Giga Berlin factory. And you also have hyper growth in their energy storage solutions. You're also looking at really interesting, compelling products that they will continue to launch in the years ahead, like the new Roadster. Because of some chip shortages, you're unlikely to see the new products this year in terms of getting rolled out, but you might start seeing them in the following years. Another one, Cybertruck, getting a lot of demand. And another one, which I think really doesn't get enough credit, is this focus on the Optimus, the Tesla humanoid robot, which I think has just immense potential over time. Even Elon Musk has called out that this business, selling effectively robots, could be well in excess of their automotive business. So that is really interesting to think about. I'll talk more about that in an exclusive letter later this week. And not only do you have all these options for significant growth from here, but there's also full self-driving, which has a lot of folks excited about. This is the year, supposedly, based on Elon Musk saying, hey, over and over again that they're going to do it. He's saying now this is the year that they're going to do it. We think full self-driving will become the most important source of profitability for Tesla. If you run the numbers on robotaxis, it's kind of nutty. It's nutty good from a financial standpoint. We're completely confident at this point it will be achieved. We'll achieve full self-driving this year, yes, with data safety levels significantly greater than at present, might end up being the biggest increase in asset value of any asset class in history as these self-driving cars become effectively worth more. That's effectively what he's targeting. And you talk about this robo-taxi, market potential. And not only do you have that optionality in terms of future profitability, but the interesting part is you're still growing at hyper speeds, or at least that's their expectation for 2022. Given supply chain constraints, which they talk about as being the limiter, they're saying, hey, yeah, we still think we're going to be looking at north of 50% growth in 2022. And so the question is, where does Tesla stock go from here? First, a quick plug where if you're interested in finding compelling ideas, potential multi-baggers that you can buy right now, check out unrivaledinvesting.com. I also share a real money portfolio that is both hyper growth as well as deep value stocks. That's unrivaledinvesting.com. Click join the journey. And so looking at Tesla, it has a lot of the attributes that I personally love to see with investments. You're looking at a company that is rapidly outgrowing its competitors. This means they are doing something that's unrivaled. You are taking share from other players. You're expanding the market potentially. And you could see, just look at their growth rate versus the rest of the industry, which is around break even or lower. And then you look at their profitability. Not only are they growing faster, but because they're, doing new levels of automation, really setting the standard for what's possible, you're also achieving greater profitability. And you see what's happened. This is as of the fourth quarter 2021. And as you look to 2022, management's already called out their first quarter production and deliveries at around 305,000 vehicles produced, 310,000 delivered. This is talking about the Model S and X as well as the 3 and the Y. And what's interesting is you compare that to last year, which was around 180 to 184,000. You're talking about continued hyper growth, between 60 and 70% growth for the first quarter. And the challenge here, because not only do you need to see strong growth, and that growth is very impressive. The challenge is that the valuation has expanded so significantly over this time period as well. So not only have they grown exceptionally fast, but I'd argue the valuation has expanded even faster, where it's gone from 1 to 2 times revenue to 19 times revenue. And so that is extremely rich. I mean, this is software level type of margins, or software level type of valuations. That is something to be mindful of. And there's 2 really important things that you need to know about multiples. The first is that the higher it is, the faster you need to grow. So the higher that multiple is, that means investors are assuming your growth rate arguably is going to be even better in the future. And I personally find that to be a little tough to believe, just given the fact that it's harder generally to accelerate your business, sell even more cars the bigger you are. You sort of start getting a law of large numbers aspect. Is it really possible that they grow significantly, let's say faster than 50% year after year after year? Or will they even be able to maintain 50% year after year after year of growth? And also another key aspect, and this is just an aspect of reality, which is that over time multiples tend to go lower. Multiples tend to reset lower. And the reason why is ultimately because those growth rates, the bigger you are, the harder it is to grow. And you could see, historically, many companies that were growing 20, 30% plus, they had really lofty multiples. But as their growth rate comes down, that valuation multiple comes down as well. Now, maybe Tesla is impervious to this. Maybe because it has such significant potential in the years ahead, full self-driving, new vehicles, robots, lots of potential, best practices with automation. Maybe there's the potential that they're able to maintain these high margins, these high multiples going forward. The challenge is, it's also possible that you have investors sort of reset their expectations and it goes to, let's say, something dramatically lower. And that's one of my chief concerns as I look at this. So it does make me wonder, is it possible that you see a great reset with Tesla stock? It's around $1,000 a share now, around $1.1 trillion valuation. Looking at, let's say, the year ahead, assuming somewhere between 50 and 60% growth, maybe that's too conservative, given that, it looks like they might be growing even faster. We'll see. Keep in mind, their margins for last year were 12%. I'm assuming 20 to 30%. That gives them a lot of credit for software profitability, which, in all honesty, this is sort of a pie in the sky, concept right now, given that it hasn't rolled out at all. So I'm giving them a lot of credit here to what the potential is, slapping on a 25% tax rate. And you could see, hey, assuming that their margins, this next year could be 20 to 30%, which they won't be, but assuming they could be, because at maturity, let's say they're closer to 20 to 30% margins, then this next year they're trading at 60 to, let's say, 100 times earnings. And is that too rich for a company that's growing at 50 to 60%? Well, the question is, how long do you think they're going to be growing at such a high rate? And this is, I welcome your feedback. I'm penciling out over the ensuing years an additional 30 to 40% annualized growth rate. So effectively going from, let's say, 80 billion in revenue in 2022 to somewhere between 200 billion and 300 billion in revenue. Where do you think that shakes out? Where do you think that profitability looks like? And keep in mind, this is a hypothetical framework. Of course, stock price can go way higher, way lower. The question is, what do you think, of these different inputs? If I look at the end multiple 5 years from now, assuming an earnings multiple somewhere between 20 and 30 times, ultimately it's going to get tougher and tougher to keep growing at such a hyper rate, I would think. And so I would think that you'd need to apply a more conservative multiple. And so looking at something like this, and keep in mind, this is more aligned with how it was valued back in 2020 or 2019. And so looking at this, what type of multiple, this would result in a dramatic reset, a dramatic revaluation in Tesla stock, even if they continue to grow significantly. Even if they grow where the business more than doubles, where it goes from 80 billion in potential revenue this year to 230 billion in revenue, by 5 years out from now, it's still possible that the stock price has a terrible return if investors say, you know what, we thought you could do 20% margins. You did 20% margins, but you know what? The valuation multiples were just too rich. So that's the tough part, as I look at this. Now, on the flip side, if everything works out, as I'm penciling out here, if everything works out where you get continued 40% annualized growth, a 30 times N multiple, 5 years from now, 30% profit margins, which is once again close to 3x where they currently are. So I'd love to see how that shakes out. Then you're effectively penciling out like 100% upside. Is that risk reward, enticing enough? I'm just not sure about that. I personally would love to revisit Tesla at a, let's say, reset valuation. But I'm just, especially because I find some of the things that they're playing for, like robot automation and, having a robot in every household, such a compelling and interesting idea over time. But the tough part is that valuation component, that, $1.1 trillion valuation. So I can't quite pull the trigger. But if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button, and thanks so much for tuning in.